If you're holding ULTY right now, you deserve the truth. Because while everyone online is flexing screenshots of massive weekly payouts, there's something most investors aren't seeing. Something that's happening quietly, right under the hood. So, we're just going to look at the facts. Plain and simple. We'll talk about how sustainable those payouts really are, what the total return picture actually looks like, and most importantly, what happens when the music stops. Because here's the thing, it's easy to fall in love with big weekly dividends. But sometimes what looks like income might actually be your own money coming back. And by the end of this video, you'll know exactly what to do, whether it's smart to keep holding, take some profits, or completely rethink your position. Here's a quick disclaimer. Nothing in this video should be considered financial advice. This content is for educational and entertainment purposes only. Always do your own research and consult a licensed professional before making any investment decisions. All right. Let's make sure everyone's on the same page. ULTY is one of those ultra-income ETFs from yieldmax. And the whole idea behind it is simple. It's built to pay you weekly income. But here's the key. That money isn't coming from traditional dividends or company profits. Instead, it comes from selling options. Basically, ULTY is writing covered calls on a stock and collecting the premiums. Now, that sounds amazing, right? Weekly cash flow, predictable payouts, it feels like a dream setup for income investors. But here's the thing, that same structure that gives you those juicy payouts can also turn into a ticking time bomb if you don't understand how it really works. So let's break down why that is, and more importantly, what it means if you're still holding ULTY right now. So here's where things start to get interesting. Everyone sees that 50% or 60% yield number and instantly thinks, wow, this is insane. Those numbers look way higher than anything you'd see in a savings account. But here's the catch. That number doesn't actually mean what most people think. It's not locked in, it's not guaranteed, and it's definitely not a steady dividend, like what you'd get from something like SCHD or VOO. That yield is based on volatility, basically how wild the market's been, and the performance of the stock sitting inside ULTY. When the market's hot, stocks are swinging and volatility is high, ULTY can sell options for a higher price, which means bigger premiums and fatter payouts. But when things calm down, when stocks start moving sideways or volatility drops, those premiums shrink instantly, and the ETF doesn't react fast enough. But even if these things are happening, you keep seeing those same big weekly payouts. But what's the catch? Those big payouts don't come free in those situations. Behind the scenes, the NAV, the true value of your investment, is slowly going down. That's why someone can make $500 in payouts and still see their total portfolio down $400. It looks like you're winning, but your account's slowly bleeding. And that's the part most investors completely miss, which leads right into the real problem, the dividend trap. Alright, so now let's talk about what I call the dividend trap. And this is where most investors get caught without even realizing it. Let's start with what's really happening behind those massive payouts. Step 1, the illusion of income. You see that huge number, 50%, 60%, even 70% annual yield. It looks like you're getting this incredible stream of passive income. But those aren't real dividends like you'd get from companies making profits. They're just option premiums, money the fund collects from selling calls. But we already know that when those premiums are paid out, the ETF's NAV drops by about the same amount. Think of it like your checking account. If you withdraw $100, your balance goes down by $100. You didn't make money, you just moved it from one pocket to another. That's basically what's happening here. You're not creating new wealth, you're just redistributing your own portfolio value back into your pocket. It feels good because you see cash flow, but your base, the actual investment that generates it, keeps getting smaller. Before we get to the next part, if you're enjoying this video, make sure to hit that like button and subscribe for more videos like this. Okay, back to the important part. Step 2, compounding doesn't save you if NAV keeps slipping. Now, a lot of people try to fix this by saying, oh, I'll just reinvest everything, I'll compound it. Sounds smart, right? But here's the issue. If the value of the fund keeps slipping every week, then you're just compounding decay. Let's keep it super simple. Say you start with $10,000 in ULTY. You get a $100 payout this week. Nice. But then the NAV drops 2%. Now your fund's worth $9,800. You reinvest that $100 and your total is $9,900. So even though it feels like you're growing, you're actually $100 down from where you started. And that pattern can quietly repeat every week. So instead of compounding wealth, you're compounding losses that are disguised as income. Step 3, the NAV drain. Here's the simplest way to think about it. Covered call, ETFs like ULTY are basically saying, I'll give up my future upside in exchange for income today. That works great when the market is flat or choppy because you're cashing in on volatility. But over time, since you're constantly selling away your upside, your capital doesn't really grow with the market. So while long-term investors in regular ETFs ride the wave up, funds like ULTY can end up with high income, but flat or even negative total returns. You're getting a paycheck every week, sure, but your investment is quietly shrinking underneath. Step 4, the market environment factor. And that brings us to the market itself. ULTY does best in a sideways or volatile market, where stocks jump around and option premiums are juicy. But when the market gets calm or starts trending up, ULTY starts lagging badly. Because like we discussed, you're giving up upside for income and miss out on all the growth while you are in a falling market. That's the nightmare combo. Your NAV drops and your premiums dry up. So those huge payouts that looked incredible during good times can vanish overnight when volatility fades or stocks slide. Step 5, the emotional trap. And honestly, this is the toughest part, the emotional side. Because getting that weekly deposit just feels good. You see money coming in and you tell yourself, hey, I'm still getting paid, I'm fine. But that's exactly how investors get stuck holding a fund, even if you know that it's quietly losing 30% in value underneath. It feels like income. It feels like you're getting money, and it's really hard to let go of that. But you have to accept the brutal truth that it's bringing down your investments piece by piece. So now that we've broken down how those payouts actually work, let's talk about something almost nobody's mentioning. And that's the bigger issue behind all of this. And that is that every single yieldmax ETF, including ULTY, has been living in a pretty comfortable world so far. Part 1. Yieldmax ETFs have never faced a real bear market. Here's the thing. These ETFs only launched in the last couple of years. And since then, we've mostly seen bullish markets where tech stocks are strong and volatility's been decent. That's like testing a sports car on an empty, smooth highway. Of course, it looks amazing when everything's going your way. But what happens when the road gets rough? What happens when volatility spikes, stocks fall, and panic hits? We still don't know, because yieldmax ETFs haven't been through a true bear market yet. Not a 2022 style correction. Not a 2020 style crash. Nothing close. So everything that looks great now might look very different when things finally break. Part 2. What happens when that day comes? Let's say the market finally turns, prices start falling hard. Here's what happens, step by step. The stocks inside ULTY, the ones it's writing options on, drop in value. When that happens, the option premiums, your income, start shrinking fast. Meanwhile, we know that your NAV is also falling. So you're not just losing on one front, you're getting hit twice. Your income drops and your portfolio value drops. That double pain is brutal. Part 3. Historical clues. Now, we've actually seen little previews of this before. Look back at early 2024. ETFs like TSLY, NVDY, and OARK all went through this exact issue. Their NAVs fell 10 to 20% in just a few months, even though they kept paying big distributions. But behind the scenes, those payouts were coming from shrinking value. ULTY could face the exact same problem. And honestly, it could be even worse because ULTY's portfolio is built on multiple things, which means more moving parts and more potential for losses to pile up. Part 4. The double-edged sword of compounding risk. Now, let's connect that to something we talked about earlier, reinvesting. When investors automatically reinvest every week, they're adding more money into a fund whose NAV might be dropping. That's not really dollar cost averaging. That's just doubling down on a losing trend. It's like pouring more water into a bucket that's leaking from the bottom. It might feel productive, but all you're really doing is accelerating value erosion. That's the double-edged sword of compounding risk. It helps when prices rise, but it hurts twice as bad when they fall. Step 5. The real risk isn't losing a little money. The real danger isn't just a dip in NAV. It's losing stability and predictability. People buy these funds for steady, reliable income. But when markets shift and volatility dries up, and those payouts drop fast, or even pause, for anyone counting on that cash flow, that's a nightmare. Because it's not just about how high the yield is. It's about how long it can actually last. Now let's see how ULTY competes against other weekly income ETFs like WPAY from Roundhill. They're both built to give you consistent payouts, but the way they go about it is very different. See, WPAY is more like the cautious cousin. Instead of chasing the biggest yield possible, it spreads risk. It invests across multiple weekly income ETFs and manages its NAV a lot more conservatively. Meanwhile, ULTY is more aggressive. Its main goal is to maximize yield, even if that means taking on higher risk and bigger swings in NAV. And the results so far show that difference clearly. In its first few months, WPAY's NAV held steadier while still delivering solid weekly payouts, just not as flashy as ULTY's. So, yeah, WPAY might look a bit boring in comparison, but sometimes boring is what survives longest. Because at the end of the day, a slightly lower yield that actually holds its value can outperform a high-flying fund that slowly bleeds underneath. Alright, so you're still interested in ULTY, maybe you already own some. That's fine. We can tweak how we use it to get the maximum benefits without throwing the future out the window. First rule, don't go all in. ULTY should be a side income booster, not the core of your portfolio. Treat it like a tool, not the foundation. Second, combine it with stable, reliable ETFs like SCHD, JEPI, or even short-term bonds. These help anchor your portfolio while ULTY provides the weekly cash flow. Third, be smart with reinvesting. I'm sure you remember that if you reinvest into ULTY, you are slowly losing money. A safer move might be to withdraw your distributions and use that cash to buy diversified, stable assets. Do this, and you're no longer just chasing yield. You're turning volatile income into sustainable wealth and avoiding the traps that catch most ULTY holders off guard. So here's what I want you to do. If you're holding ULTY, drop in the comments how much your total return has been, not just the dividends. Let's see the real numbers and have an honest conversation. And if you want to know how to build a portfolio that pays weekly without burning NAV, check out this video to find out the perfect retirement portfolio.